When you monitor global capital flows for long enough, you kind of get used to the normal rhythm of market corrections.
Right. There's usually a very specific pattern to it.
Exactly. You see credit spreads start to widen, maybe the volatility indexes twitch a bit, and then you get this orderly unwinding of positions.
Yeah, it's mathematical. It's expected.
But over the last 48 hours, the precious metals market didn't just correct. It basically experienced this localized gravitational collapse.
That is probably the best way to describe it, honestly.
Right. I mean, a 2-day wipeout that just erased $260 per ounce from gold. That is not a standard pullback.
No, absolutely not. That is a violent structural recalibration of value. It's the kind of price action that forces every quantitative model on Wall Street to just instantly recalculate its baseline.
Oh, I bet.
The sheer velocity of the capital exit we just witnessed, it's entirely different from standard profit taking.
And that is exactly what we are unpacking today. Welcome to this morning's deep dive for June 19th. We are looking right at you, the listener, to help you figure out exactly what is happening under the hood of this market.
There's a lot to cover today.
There really is. But before we tear into the mechanics of this massive sell-off, just a quick reminder, we are here strictly to analyze the data and the macro environment, right? Not to offer personalized financial advice.
Exactly. You have to make your own decisions out there.
Yep. And if you are navigating these crazy charts alongside us, take a second to hit the like button, subscribe to the channel, and drop a comment below with your own perspective. Where do you think this capital is rotating?
We'd genuinely love to hear your thoughts on this.
For sure, because we are dealing with an incredibly complex landscape today. Our mission is to dissect the main catalyst driving this $260 plunge. We're going to look at the glaring absence of physical buyers in Asia, unpack the dual pressure that is just crushing silver right now, and map out the strategic levels you need to watch.
And, to accurately map where we are going, we first have to establish the precise dimensions of the floor that just fell out.
Right.
The context of the sheer scale here is it's non-negotiable. We have to start there.
So let's lay out the hard data for everyone.
Right.
We watched gold plummet over 2 consecutive trading sessions, carving out a brutal low of $4,122 per ounce by, about 1:00 a.m. this morning?
Yeah, right around 1 a.m.
And we have seen a very, very marginal technical stabilization since then, sort of hovering around $4,160. But, the chart is completely broken.
It's totally detached from its previous trend.
And silver was arguably worse.
Oh, much worse.
Silver dropped $8.20 across those same 2 sessions. It bottomed out at $63.30 before, scraping its way back to 65.
Just staggering numbers.
It really is. But looking at these numbers, I feel like we need to make a critical distinction for the listener here.
Go for it.
This drop, as violent as it was, it doesn't carry the hallmarks of a liquidity crisis.
No, not at all.
We aren't seeing the kind of indiscriminate panic selling we saw back in, say, March 2020. Remember when funds were just liquidating gold simply to cover margin calls in totally unrelated asset classes?
Yeah, that distinction is absolutely paramount because a liquidity panic is emotional, right? It's chaotic.
People are just screaming, "Get me out."
Exactly. Institutions in a panic will sell whatever they can find a bid for just to raise cash. What we observed over the last 48 hours is entirely different.
So what was it then?
This is a highly calculated, deliberate structural repricing. Large pools of institutional capital didn't freak out. They purposefully adjusted their valuation models based on a massive fundamental shift in the macro environment.
Okay, so they looked at the data and just ran the new math.
Precisely. They looked at the forward yielding curve, realized the opportunity cost of holding a non-yielding asset had just drastically increased, and methodically rotated that capital out of metals.
Which brings us directly to the source of that fundamental shift, the Federal Reserve's FOMC meeting.
The big catalyst.
Right. But this is where the market's reaction demands some serious scrutiny, because the Fed actually kept interest rates completely unchanged.
They did.
They held steady at that 3.5 to 3.75% range, and let's be honest, the market already knew the Fed was leaning hawkish. We've seen tough forward guidance before.
Also, constantly. For the last year, really.
Traders have spent the whole last year calling the Fed's bluff, just assuming a pivot was always 6 months away.
Yeah, the classic pivot party mentality.
Exactly. So why did the market suddenly believe them this time? Why did a literal pause in rate hikes trigger a $260 structural collapse?
Because the Fed didn't just extend the timeline for high rates. They altered the actual terminal destination.
Oh, interesting. What do you mean by that?
Well, traders can stomach a delay in rate cuts, right? As long as they believe cheap money is still waiting for them somewhere on the horizon.
Sure, they can just wait it out.
But the new dot plot revealed that 9 out of 19 Fed members see inflation as far too sticky above that 2% target.
Right, the dreaded sticky inflation.
The true catalyst, though, was their projection for 2026.
Okay, lay it on us.
By forecasting an average interest rate of 3.8% 2.5 years from now, the Fed essentially dismantled the market's core assumption.
The assumption that we were returning to a zero interest rate environment?
Exactly. They killed the idea of zero interest rates returning anytime soon.
Wow. So it fundamentally changes the math of the yield seesaw.
The yield seesaw, I like that.
Yeah, think of global capital allocation like this massive seesaw. On one side, you have the US dollar and treasury bonds, which are now heavily weighted down by the promise of sustained near 4% yield stretching all the way into 2026.
Right.
And on the other side, you have gold and silver, which yield absolutely nothing.
0% yield.
Right, so when you stack that much guaranteed risk-free future yield on the dollar side of the seesaw, the mathematical gravity forces the non-yielding metals high into the air, completely stripping them of their value.
That's a perfect analogy. You can see it in the data. The dollar index, the DXY, surging to 100.77 points isn't just some arbitrary metric.
No, it's a huge deal.
It is the physical manifestation of that capital rotation you just described.
Huh?
The DXY hitting a one-year high confirms that global capital is aggressively locking in those yields.
So it's basically the smart money moving to the sure thing.
Exactly. Institutional investors run strict net present value models. When the discount rate used in those models stays elevated for years, the present value of an asset that generates zero cash flow drops precipitously.
It just plummets.
Right. That is the structural repricing we're talking about. It isn't a rejection of gold's inherent worth or its history. It is a clinical mathematical response to a much higher cost of capital.
Okay, but under normal circumstances, when an asset undergoes a clinical repricing of this magnitude, essentially a $260 discount, the physical market usually acts as a shock absorber.
That's what you would historically expect, yes.
Right. You'd expect sovereign wealth funds, central banks, and massive retail markets in Asia to step in and absorb the excess supply because it's suddenly on sale.
Bargain hunters, essentially.
Exactly. But looking at the Reuters data from our sources today, the physical buyers have completely vanished. The street is empty.
It is remarkably quiet out there.
In India, which is historically a massive pillar of price support on the dips, buyers are incredibly cautious right now.
Very hesitant to step in.
And in China, the market actually shifted from trading at a premium to trading at a discount compared to the global spot price.
That shift to a discount in Shanghai is, honestly, perhaps the most glaring indicator of weak sentiment we have right now.
Why is that so significant?
Well, you have to look at the broader macroeconomic picture in China to understand why the retail buyers aren't trying to catch this falling knife. The People's Bank of China recently paused its massive 18-month gold buying spree.
18 months of solid buying, and they just hit the brakes.
Yes. And when the PBOC stops accumulating, it sends a powerful, unstated signal to the domestic market.
That the state considers the metal fully valued.
Or perhaps even overvalued at current levels, exactly.
Wow. So local wholesale dealers suddenly find themselves holding all this inventory that the central bank is no longer soaking up.
Right. The guaranteed buyer just left the room.
So they have to offload it to the retail sector. And to convince regular people to buy it, they literally have to drop the price below the global benchmark.
Exactly. It's a classic oversupply dynamic playing out locally. And that completely removes China as a support pillar for the global price.
That is fascinating.
And, that domestic caution is compounded by broader economic headwinds all across Asia.
Like the real estate issues?
Yes, real estate pressures, currency, defense strategies. The capital that might usually flow into gold on a dip like this is instead being heavily preserved.
Right. People are hoarding cash. So the physical demand pillar is gone. That leaves the geopolitical pillar, right? The classic fear trade.
The fear trade, yeah.
Usually, global instability provides a really reliable floor for precious metals, but the sources highlight a major development there as well.
Right, the Middle East situation.
Yeah, the U.S. and Iran actually announced a temporary agreement aimed at reducing tensions. Now, On the surface, easing tensions obviously reduces the immediate demand for safe haven assets.
Naturally.
But the real damage to gold here is how this geopolitical cooling mechanically feeds back into the Federal Reserve's inflation models.
And it does it right through the oil market.
Exactly. Can you break down that feedback loop for the listener?
Absolutely. So the geopolitical risk premium in the energy markets evaporated on that Iran news. We saw West Texas Intermediate, or WTI, drop to $76.93 a barrel.
A significant drop.
And Brent crude slid down to $80.47.
And when crude oil drops, literally the input costs for manufacturing, shipping, and raw materials drop globally.
Everything gets cheaper to move and make.
Right. Which means the Personal Consumption Expenditures Index, the CPI, all the metrics the Fed tracks obsessively will naturally start to cool off.
Which you'd think is a good thing.
But it creates a perverse scenario for gold, doesn't it?
It absolutely does, because cheaper oil actually gives the Fed a free pass.
How so?
It allows them to keep interest rates stubbornly high without immediately crushing the consumer or triggering a severe recession. They get the disinflationary pressure from the energy sector without having to induce it entirely through their own monetary policy.
Wow. So it just extends their runway.
Exactly. It extends their runway to maintain that hawkish posture. The temporary Iran deal didn't just remove geopolitical fear, it actively suppressed inflation expectations.
Which cements the higher for longer yield environment.
Right, which in turn supercharged the US dollar and crushed gold. It is a completely seamless chain of causality.
Man, everything's just stacking against gold right now. Which brings us to the unique nightmare-facing silver.
Oh, silver.
If gold was pushed down the stairs by this strong dollar environment, silver was basically thrown out the window.
That's putting it mildly. Down $8.20.
And that massive underperformance is rooted in the fact that silver doesn't just sit in a central bank vault looking pretty. It is inextricably tethered to the factory floor.
Yes. The dual nature of silver is its greatest asset in an economic boom, but it becomes a massive, heavy anchor in a contraction.
Right, because it's an industrial metal, too.
We have already established the monetary pressure, right? The high yields pulling investment capital away. But silver's industrial demand profile makes it highly sensitive to the exact same interest rates that are crushing its monetary premium.
You mean like its use in the photovoltaic supply chain and broad electronics?
Exactly. Let's trace that industrial mechanics specifically because it's vital for the listener to understand.
Walk us through it.
High interest rates don't just offer better yields for bond investors. They drastically increase the cost of capital for massive industrial projects.
Okay, so give me an example.
Say you are a utility company planning a massive 100-megawatt solar farm.
Okay.
Your financing costs just skyrocketed. If borrowing costs remain near 4% all the way into 2026, the return on investment for that project completely collapses.
Because the debt is just too expensive to service.
Precisely. So the project gets delayed or even canceled. And the thousands of ounces of physical silver that would have been required for all those solar panels,
they just sit in a warehouse.
they simply stay in the warehouse.
So the monetary policy is actively destroying the industrial demand baseline.
Exactly. Silver is essentially pricing in a manufacturing slowdown before it even fully materializes in the broader economic data.
The algorithms are front-running the recession.
That's exactly what they're doing. They recognize that sustained high interest rates will inevitably compress industrial output, so they aggressively front-run that reality by dumping silver contracts. Silver is experiencing monetary tightening and industrial demand destruction simultaneously.
A literal double whammy. So, with the floor seemingly giving way across both metals, I think the most immediate question for the listener right now, especially if they are managing their own exposure, is where does this structural repricing actually stabilize?
That's the million-dollar question.
The short-term picture from our institutional sources seems to be dominated by sustained volatility. I mean, we aren't expecting a V-shaped recovery while the market is still digesting that 2026 dot plot, right?
No, a V-shaped recovery is highly unlikely here. But the technical levels are actually incredibly well-defined right now.
Okay, what numbers are we looking at?
The $4,120 to $4,150 zone is acting as the immediate, albeit very fragile, support for gold. We saw it bounce slightly from $4,122 today.
Which indicates what?
It indicates some automated buying programs actually recognized value there and stepped in.
Okay, so that's the floor. What about the ceiling?
On the upside, any rally is going to run into severe resistance between $4,220 and $4,280. But macro environment simply does not support a breakout above that range right now.
But the institutions in our sources are also floating a much heavier warning.
Yeah, the big one.
If the dollar index maintains its strength above 100 and those bond yields refuse to compress, the market is very likely to test the massive structural level of $4,000 an ounce.
That is a very real possibility.
And when you approach a large, round psychological number like 4,000, you run the risk of triggering massive stop losses, right? Like momentum-driven selling that just ignores fundamentals entirely.
Oh, absolutely. Testing the $4,000 level would certainly induce a wave of negative sentiment across the board. But I think it is vital to separate short-term price discovery from the long-term macroeconomic tectonic plates.
Explain that.
The major multi-year uptrend in precious metals is not invalidated by this single repricing event. If gold can defend that $4,000 structural base, the long-term thesis remains incredibly robust.
Because the forces driving that long-term thesis, sovereign reserve diversification, the fracturing of global trade mechanisms, the unsustainability of sovereign debt levels, none of those issues were solved by a single FOMC meeting.
Exactly. A hawkish dot plot doesn't fix a trillion-dollar deficit.
Right. Central banks outside the G7 are still executing this methodical, decade-long strategy to de-dollarize their reserves.
Yes. They might pause their buying to let the retail market find a bottom, like we saw with the PBOC, but their structural mandate to acquire physical metal hasn't changed at all.
So institutional capital knows this.
They absolutely know this.
Yeah.
They are just waiting for the volatility surface to calm down, for the new baseline to be firmly established before they begin accumulating again.
So the strategic takeaway for you, the listener, isn't just a generic warning to avoid leverage or to blindly average down into a falling market. It is about aligning your behavior with institutional capital.
Perfectly said. The sources emphasize a highly disciplined approach for the current environment.
Let's outline those steps. First off, do not chase sudden, aggressive upward spikes.
No, never.
In a market undergoing structural repricing, those sharp rallies are almost always liquidity traps, right? Designed to catch offside retail traders before the next leg down.
They will trap you every time.
Second, recognize that managing risk right now means managing your time horizon. If you are positioned for a long-term macroeconomic shift, applying short-term leverage will basically guarantee you are shaken out of your position before the thesis actually plays out.
Yeah, you'll get wiped out by the chop.
Right. Capital preservation during this recalibration phase is far more critical than trying to pinpoint the exact absolute bottom. If you are an accumulator, dollar cost averaging is your friend here.
You have to respect the transition period. We're moving from a market that anticipated imminent rate cuts to a market that must endure a prolonged period of restrictive capital costs.
It's a new reality.
And until the broader economic data forces the Fed to abandon that 2026 projection, the U.S. dollar will command the flow of global liquidity.
It is a profound shift in market reality. To synthesize everything we've unpacked today, the $260 collapse was not a random panic. It was the mathematical consequence of the Fed resetting the timeline for the cost of capital.
Correct.
Gold hasn't failed as a safe haven. The market has simply calculated that the yield-bearing safety of the U.S. dollar is a mathematically superior harbor while we wait to see if the economy can actually handle these rates.
That's the core of it.
And silver is just bearing the brunt of both the monetary shift and the anticipated industrial slowdown. The capital is strictly following the yield.
Always does.
Now we turn it over to you. As you watch these technical levels interact with the macro data, what is your thesis? Has gold truly established a fragile floor around $4,120, or is this just a brief consolidation before we test that psychological $4,000 mark?
Let us know.
Yeah, leave a comment below with your analysis. And if this deep dive helped clarify the mechanics driving your charts this morning, please like the video, subscribe, and turn on notifications so you are always prepared when the market structurally shifts.
Before we go, there is one crucial variable we haven't really factored into this newly established baseline.
Oh, what's that?
It's something you should really keep in mind as you watch the price action unfold over the next few weeks.
Okay, lay it on us.
The entire justification for this massive $260 repricing is predicated on the Fed's dot plot, right? Their forecast of where the economy and interest rates will be in 2026.
Right, that 3.8% number.
Exactly. But if history has proven anything, it is that central bank long-term forecasts are notoriously, almost predictably inaccurate.
That is very true.
The market just ruthlessly priced in a reality that is 2.5 years away. So ask yourself, What happens to this newly established strong dollar baseline the very second a significantly deteriorating jobs report or a sudden shock to the credit markets proves the Fed's crystal ball is fundamentally broken?
Wow. The moment the data invalidates the forecast, the algorithms will have to reprice the market all over again, but in the opposite direction.
Exactly. Keep your eyes on the data, not just the dots.
That is a phenomenal point to end on. Thanks for joining us for this deep dive. We will see you next time.